Welcome to our Lively U Virtual Learning Academy. Today's program is entitled Outlook and Opportunities Within the Finance World. We are welcoming Chad Plantz from Edward Jones. 2020 started off right where 2019 had left off. Market conditions quickly changed as a pandemic spread globally. The road ahead could be bumpy, but we believe the economy will continue to recover this year. In this presentation, he'll look at the following key topics and questions facing investors today. Will the economy rebound? What role will stimulus play? Do stocks still have room to run? Where, where will interest rates go from here? Last year's winners could be this year's losers. Looking at the long run. Please welcome Chad Plantz.
Danielle, thank you very much. Appreciate it as always. We always look forward to meeting with folks here, obviously virtual still, but hopefully in the near future with folks in person. So, good afternoon to everybody that's watching today via Zoom. It's great to be here with you. And, my name is Chad Plantz. If we have not met before, I'm a financial advisor here with Edward Jones in Bowling Green. We're located at 519 West Wooster Street in Bowling Green near downtown. I've worked with Edward Jones here for several years now and became a financial advisor just due to my passion to help people and my passion for investing and just helping people reach their financial goals. Once again, that's one of the many reasons that we've partnered here with the Senior Center to bring educational topics like this to folks and just meet folks in the community. So hopefully you're able to see my screen here today. What we're going to be talking about, obviously, as Danielle had briefly mentioned there, a couple different things. So, 2020, as she had stated, that it started off right where 2019 had left off, right? So a banner year for stocks with the best performance since 2013. But market conditions quickly changed as the coronavirus pandemic spread globally in efforts to limit the the global demand. So as the spread of the coronavirus gripped the nation, the world last year, the economic activity kind of paused, and and so did the bull market, the second longest bull market in history, actually. So as for, I guess, definition purposes, you may be asking yourself, what is a bull market? What is a bear market when you hear those types of things? So a bull market is any time that the market from its low spot raises by 20%. So, and vice versa, when we hit market highs, if we see a 20% pullback, that's what technically would define a bear market. So, once again, the bull market that we've seen, the second longest in U.S. history, ended obviously abruptly. So, stocks rallied from their March 2020 lows in April and May. So, even as the economic conditions weaken considerably from previous pre-pandemic levels. So the road ahead could be bumpy, but we believe the economy will continue to recover this year. So strong stimulus measures and company earnings growth are a tailwind for markets. So you may be wondering if stocks will continue to climb to new highs, and when will the economy fully recover? So today we'll explore various macroeconomic backdrops and equity-related analysis to help you better understand the future of your portfolio. And we'll look at the following key topics and questions facing investors today. And much like Danielle had mentioned, the first thing being, will the economy rebound? Two, what role will stimulus play? Three, do stocks still have room to run? Where will interest rates go from here? Last year's winners, could be this year's losers, and looking at the long run. So we will start off here with, will the economy rebound, right? Well, COVID-19 and the global efforts to contain the virus abruptly ended the U.S. Economic expansion that began all the way back in 2009. So from 2009 to early 2020, it was the longest in U.S. history in terms of economic expansion. So the economy is a central tenet of the global investment environment. So a healthy economy helps support corporate profits, which are a powerful driver of long-term stock returns. This raises the key question once again, will the economy rebound? So what you're seeing here now then, so as far as economic expansion, the U.S. and the global economies entered recession technically in February of 2020 as a result of coronavirus and once again the unprecedented worldwide measures to contain its spread. Worldwide economic and shutdown. So it's important to recognize that this economic downturn was triggered by a biological crisis, not a financial crisis, like we saw back in 2008 and 2009. Well, however, the path ahead will also be influenced by biological factors as companies move quickly on a coronavirus vaccine like we've seen, that we need for the conditions to begin to return to some normalcy, right? And we've started to see that here over the last, not even month. So government officials across the globe are now looking at quickly ramping up distribution of these vaccines to speed up the economic recovery. The U.S. economy actually declined by nearly 32% in the second quarter of 2020, so the largest quarterly decline on record. This was followed by more than a 33% rebound in GDP in the third quarter. So driving this rebound was strong growth in consumer spending as the U.S. economy showed resiliency by moving to online platforms, right? Being innovative in the way we, the economy worked, right? So also driving the recovery was a coordinated monetary and fiscal stimulus effort to counter the effects of the shutdowns. We think in 2021, we think that 2021 will begin a multi-year economic expansion with widespread distribution of vaccines, sparking progress toward the new normal for the U.S. economy. So meanwhile, the 1-2 punch of monetary and fiscal policy stimulus will keep a tailwind at the economy's back. The resiliency and vibrancy of the U.S. economy should show as the year progresses. GDP entered the year below pre-pandemic levels, and sufficient slack remains in fuel above average growth as the recovery gains traction still. So the winter surge of COVID-19 cases and new restrictions will likely take a toll on the economy and labor market in the months ahead. We expect a slowdown in the first quarter when it comes to GDP. We've seen that as areas such as retail and leisure and hospitality remain depressed until the economy enters a post-vaccine phase. So beyond the first quarter, though, which obviously we're through now, the outlook brightens as the vaccine rollout clears the way for self-sustaining rebound and economic activity, much of what we've seen so far. As virus-related restrictions ease, which now we're just starting to see pent-up demand unleashes, right? As you've seen maybe on the news recently, the news this morning actually even mentioned that over this holiday weekend, the number of people traveling and that airlines are selling out flights. So as you can see, once again, the pent-up demand is really showing here. So we expect the economy to be closer to its normal state by the end of the year, really. A return to typical spending habits will further heal the labor market and really facilitate a faster and even more economic recovery. So. There we go. So one key driver of the rebound has been the immediate and sizable fiscal monetary stimulus. So what role will stimulus play in 2021? And is it here to stay? So significant monetary stimulus will keep short-term rates near zero. So in terms of the Fed, right, prevent longer-term rates from rising with economic rebound, and continue to supply liquidity and to support investor risk appetite. So we think this sets a backdrop for stocks to actually outperform bonds again this year. The Federal Reserve's new approach to average inflation targeting will, in our view, keep Fed stimulus in place longer into this expansion than it has in the past. But we expect the financial markets will eventually have to wrestle with the prospects of tighter Fed policy. So this graph actually illustrates how this extraordinary stimulus has translated into a sharply higher money supply and lower treasury yields. The Fed's balance sheet has expanded to roughly $7 trillion, with 10-year treasury rate near its lowest level on record. We expect the Fed to actually keep rates near zero for at least the next 2 years, even with the increasing likelihood of COVID-19 vaccines boosting activity here in 2021. There will still be significant slack in the economy and labor market by the year end. So because of this, the Fed will avoid tightening policy prematurely and a risk to repeat, a repeat of the 2013 taper tantrum, which saw a surge in treasury yields after the Fed communicated it would actually reduce the pace of its asset purchase program. So with that said, investor fears about tapering could still create short-term volatility. Under its recently updated policy framework, the Fed will tolerate above target inflation to make up for earlier shortfalls, with consumer inflation expectations anchored at low levels. It will take time to achieve this objective. Now, the pandemic has pushed the budget deficit to record levels. So the U.S. federal debt will likely rise above 100% of GDP in 2021, only for the second time in history. So the first time was during World War II. Rising GDP will help slow the ascent, but with 50% of the budget going to entitlement programs such as Medicare and Medicaid and Social Security and other fiscal aid packages needed to help get the economy to the other side of the pandemic, government debt will continue to climb this year. This is not a pot set to boil over immediately. However, while obviously debt as a percentage of GDP is headed for historic highs, it actually remains below levels that will initiate financial stress or insolvency. Fortunately, the U.S. remains one of the more vibrant economies in the developed world, and low interest rates will allow the government to borrow at low cost for some time to come. So, nevertheless, shifting demographics and ongoing structural deficits are likely to make rising government debt a more prominent risk down the road. We don't think this will threaten long-term opportunities in investment markets, but elevated government debt does pose a headwind to potential economic growth over time. So it can limit the flexibility of fiscal policy, raise interest expense, and if left unchecked, eventually crowd out private investment. So right slide there. Here we go. So further improvement in the labor market will be a key driver to a durable, self-sustaining recovery in 2021. The unemployment rate has declined at a much faster pace than in previous recessions, but there's still plenty of lost ground to make up. A little more than half of the jobs lost back in March and April have been recovered so far. The prospects of effective COVID-19 vaccines and a faster return to normal, improve the medium-term outlook, really. However, the recent surge in coronavirus infections and hospitalizations that we saw here back in the first quarter could weigh on the economy and job creation in the near term, especially in industries impacted by social distancing measures such as leisure and hospitality, of course. So we don't think unemployment will snap back to a pre-pandemic level of 3.5% in 2021, but the labor market will continue to heal as the economy gradually reopens. Once consumers return to their typical spending habits, jobs in some of the labor-intensive services such as travel and hotels and restaurants could return fairly quick. So monetary and fiscal stimulus plays a big part in keeping the labor market afloat and preventing the death spiral, where unemployment leads to more unemployment by reducing consumer spending. So stimulus checks and unemployment benefits fill the income gap temporarily, but they cannot do so indefinitely, of course. Recent fiscal stimulus acts have targeted unemployment by providing short-term funding measures to businesses through, as we saw over the last year, PPP programs or direct loans even. So, um, we'll move on to the, do stocks still have room to run, right? A lot of things here in terms of the performance last year. Even though some of the if you were looking at some companies, although the market was down nearly 34% at one point, there were still companies that were trading at record highs. So interesting when you look at the equity market. So the equity market is actually up more than 60% from its lows back in March of 2020, highlighting what might appear to be a disconnect between the market and the real economy. So this is a reminder that stock prices reflect expectations of the future and not simply just current conditions. The pandemic-driven decline in corporate earnings, along with rising stock prices, has pushed stock valuations to really elevated levels. While this can pose a risk for market performance, we expect earnings growth in 2021 to be quite strong, which should help reduce valuations as we advance. Now, the coronavirus-driven bear market was, once again, one of the swiftest on record. Taking only 6 days to fall 20% from the previous peak, after losing almost 34%. The bear market actually bottomed on March 23rd. So, shortly turning into another bull market, right? The previous bull market lasted more than 210 months, and was the second longest on record. So with the S&P returning almost 300%, the length of and magnitude of a stock market, returns following a bear market, set a good precedent for the bull market to continue to climb in years ahead. So next slide here. We expect a durable expansion really over the next few years, setting the stage for an extended bull market. So as the cycle advances, we anticipate a rotation in investment leadership. Periodic economic setbacks and vaccine disruptions could spark bouts of volatility, of course. And we suspect tax and regulatory policy proposals under the new administration here, they may grab the market's attention later in the year as well. Now, we think equities have further upside ahead, but we expect more modest returns this year compared to, with the 25% annual average over the past 2 years, which is just, been outstanding. Earnings growth of 20% is likely this year, and we expect stretch valuations to normalize somewhat. So the current forward price to earnings ratio of about 22 is already pricing in a fairly healthy economic and earnings rebound in our view. The years 2004, 2010, and 2018 each experienced 20% earnings growth and a contraction in the P multiple. So with the S&P delivering an average return of 7.2% in those years. So once again, 2004, 2010, and 2018. So early on in those expansion periods or early bull markets. So investors who align their decisions with their goals rather than the headlines last year, and kept a level head, that's the important part here, right? Sticking to an investment plan really meant experiencing a 34% drop and a 67% recovery in large cap U.S. stocks. Since 1985, stocks have dropped an average of about 14% during the calendar year. So that's what you're seeing here in this slide. So as you can see, once again, the red dot that you're seeing there on the screen indicates the low spot for the year. The blue lines that you're seeing indicate where did we finish for the year, right? So even though in every single year that you're seeing on the calendar there, the stock market was at a negative at some point in time during every single year. But as you can see, the majority of the years did finish positive. So even though stocks can face short-term volatility and intra-year declines, it's important to keep an eye toward your portfolio's long-term strategy, right? Maintaining a long-term outlook will help you avoid making costly mistakes and keeping your portfolio on the right path, and really avoiding emotional decisions. Systematic investing and rebalancing helped investors navigate volatility last year without, timing the market. A 60-40, 60% equities, 40% bond portfolio in February of 2020 would have drifted to more of a 50-50 mix by March because of the market fluctuation. So investors who trimmed overweight investments. So once again, if you were trimming those overweight areas and reallocated to underrepresented areas over the course of the year, not only boosted their equity exposure at depressed prices, right, giving you the opportunity to buy low, right, but it also helps position portfolios for change in market leadership. So where will interest rates go from here, right? So the future path of interest rates is important for investors with income generating portfolios and money market accounts, right? So expectations for future inflation have been rising for the first time in years. The 10-year break-even rate, so a market-based measure of inflation expectations, rose to the highest level since 2018 amid rising commodity prices. So a low dollar and a broad policy support, we think the slack in the labor market will limit inflation pressures in the near term, but a sustained economic expansion will, in our view, drive moderately higher inflation in the future. Sorry about that, went the wrong direction. There we go. So this table shows 7 periods since 1990 when benchmark 10-year rates rose noticeably. So in 6 of those instances, the S&P increased at a faster than average pace and only fell slightly during one lagging period. So also worth noting is that there are 3 of those periods, 2009 through 10, 2012 through 14, and 2016 through 18, occurred during the last economic expansion, despite disappointing inflation and growth trends. So as history shows, the rising bond yields have been associated with periods of accelerating growth, which explains the above average equity market returns. So as you can see from this chart, both core and headline inflation saw a small but significant drop during the pandemic, followed by a tick up as demand returned to the market. As a reminder, headline inflation includes all goods, while core inflation excludes, food and energy, which can be more volatile, of course. However, both measures remain well below the Fed's target rate of 2%. So if you recall, inflation spiked in the 1970s and 80s, which prompted rapid monetary tightening, causing a recession. So we believe inflation will remain, muted through 2021. The Fed's new approach toward targeting average inflation over time will, in our view, mean the Fed will keep stimulus in place and interest rates low for the next several years, really. So inflation has often been linked to unemployment and wage growth. So wage growth typically accelerates as unemployment falls, reflecting higher competition for labor. So while unemployment spiked last year to historically high levels, remains elevated even today, household income has been supported by federal aid. So we think labor market conditions will heal further this year. As the economic expansion gains traction, we think rising wages and increased consumer confidence will support slightly firmer inflation. And so number 5 here of 6 here. So this is last year's winners could be this year's losers, right? The stock market rally has been led by the technology sector. So however, with the global economy rebounding, we believe a sustained economic expansion will spur rotations in leadership. So this can benefit asset classes, sectors, and areas of the market that have lagged or are more sensitive to cyclical economic conditions, really. So the second half of the year could see first synchronized pickup in growth across regions since 2017. So the resurgence of COVID-19 cases and renewed lockdowns in Europe likely resulted in negative GDP growth in the fourth quarter. However, stronger fiscal and monetary policy, coordination across Europe, and an eventual vaccine distribution, should help spur the recovery as European economies emerge from the lockdown. A handful of U.S. large cap tech names accounted for a disproportionate share of the market gains in 2020. As I had mentioned earlier, a lot of the companies saw quite a good year. So between January and the end of October, shares of 5 of the 6 largest companies in the S&P, so that would be Apple, Microsoft, Amazon, Facebook, and Google, rose by 38% on average, compared with a 1% increase in the other 495 stocks in the S&P 500. So we believe that as the economic reopening accelerates in the second half of 2021, the rally will broaden to economically sensitive investments that have lagged. And this includes small cap and even international, stocks. So cyclical sectors, face easy earnings comparisons in 2021 and trade at discounted valuations. But pandemic, trends such as digitalization and staying at home are likely to last and will continue to support the tech stocks. So we recommend investors maintain appropriate diversification once again to benefit from the increased participation from stocks across market caps, investment styles, and even regions. So once again, diversification, right? You've probably heard that a lot. China has been a key engine of global growth over the past decade, and a growing influence over the past 2 decades. It has grown from just 3% of the global economy in 1998 to an estimated 17% of the world's GDP last year. So China's growth and broad trading arrangements have also helped spur growth in other developed economies across Asia as well as in the Eurozone. So China has led the way on COVID-19 containment, is the only major country expected to grow its economy in 2020 and 21. Given the timing of its containment measures and policy stimulus, China appears slightly further into the new expansion. We expect solid economic growth across Asia as well, which should support emerging market equity returns. While trade relations are likely to be less contentious this year, we suspect periodic tensions between the U.S. and China will trigger occasional market anxiety also. All right, looking at the long run. So it's important to ensure your investment decisions are aligned to your situation and financial goals, not the headlines or the short-term events that we see oftentimes in the news. So doing so can help you keep on track toward your goals, and even as markets fluctuate along the way. So, all right. As this chart shows, consumers tend to have more confidence about the economy when their preferred party is in office, of course. So Democrats expressed higher levels of confidence between 2008 and 16, right, when President Obama was in the White House. Since 2016, Republicans, tend to report higher levels of confidence under President Trump's administration. So independents tend to exhibit confidence at levels between the two political parties. The lesson here is that playing politics with your portfolio could have caused you to miss a strong stock market performance under both administrations. So with a democratic transition, don't let political preferences stop you from making the investment decisions that can really help you reach your personal goals. So one common investment mistake is betting on last year's winners, right? And it's really a normal mindset. The normal mindset for people is looking at what has already performed well. So just because an asset class performed well the year before doesn't mean it will be a leading performer in the future. In this chart, asset classes are actually ranked each year from the highest to lowest performing. In 2017, the highest performing asset class was emerging market equities. but in 2018, it was cash. And in 2019, large cap stocks outperformed every other asset class. And in 2020, small cap stocks led the rebound, right? History shows that leaders do change from year to year, and often it's hard to predict, which asset class will perform the best. We believe that carefully combining a variety of specific asset classes, helps improve your portfolio's diversification even further. So this chart shows the asset classes we believe should be part of most portfolios and the annual total return of each, right? So this too shows there is no pattern to investment returns over time. You can help reduce your portfolio's volatility by owning a mix of asset classes that you see here on this chart. All right. It may be challenging to stay patient during periods when portfolio diversification doesn't seem to work, right? But most of you know that one of the most powerful drivers of long-term returns is the amount of time invested. This table shows the chances of positive returns over time from it. We learn the following, right? So staying invested over longer periods of time increased investors' chances of earning positive returns. That's true for stocks, a mix of U.S. stocks and bonds, and a better diversified portfolio that includes even international stocks. The percentages rise as time increases. Adding fixed income increased the chances of earning positive returns across all periods compared to owning just stocks. The better diversified portfolio, which includes a combination of U.S. and international stocks as well as fixed income, actually had the highest chance of positive returns over all periods. So as unsettling as it may seem, risk and volatility are part of investing, right? So history shows investors can expect a 5% dip in the market about 3 times a year on average. And a 10% correction about once a year on average. So a bear market every 3 to 4 years on average. Recent market swings have felt even more jarring because of the most recent bull market was actually marked by lower than normal volatility. Before last year, there had not been a bear market in nearly 11 years, right? So in 2019, there was no market correction of 10% or more. Which, once again, out of the norm, right? So to make it easier to construct an appropriate portfolio, we organized all asset classes into our investment pyramid that you're seeing here on the screen. In addition to the U.S. and international large cap stocks, we believe it's important to add stocks of smaller companies, which generally are more volatile, but also don't move in lockstep with larger company stocks, right? So our recommendations are designed to help you own enough of each asset class in our investment pyramid to help you achieve your long-term financial goals. So this table actually highlights the importance of staying invested in a balanced portfolio that is diversified with an appropriate mix of stocks and bonds. In it, we compare the performance of 2 hypothetical portfolios through the last 2 market cycles. The first portfolio is invested 100% in large cap U.S. equities, while the second holds 65% in equities and 35% in fixed income. Notice the difference in performance through the market cycle. So starting with the bear market tech crash that happened, that was between 2000 and 2002, the 100% stock portfolio returned a negative 46%. The balanced portfolio, which included bonds, also lost, but the decrease in return was much less, right? Instead of the negative 46, it was down 18%. So on the flip side, though, during the housing boom from 2002 to 2007, the 100% stock portfolio outperformed, returning 115%, compared with the 72% from the balanced portfolio. So as you can see by tracking booms and busts over the past 10 years, the all equity portfolio rose higher during the good times, but also fell more sharply during the bad periods. So however, over the long haul, a balanced portfolio with bonds and equities posted very similar returns than with equities alone, right? So, but with lower volatility along the way was the key, right? Can you stomach those ups and downs? So Now, I know this is a lot of information that we covered here today, and obviously, would love to open this up to any questions. But once again, I'll pass this back to Danielle. You can always reach out to me if you have specific questions about your situation. Once again, my name is Chad Plantz here with Edward Jones in Bowling Green, and feel free to reach out to Danielle, and we'll look forward to seeing people in person here soon. So.
Thank you so much, Chad.